Hey there, fellow traders. Let's talk about something we all crave in the market: an edge. We want to make smart decisions that lead to profits. But how do we get there? The answer is simple: information. In the world of trading, knowledge is power. The more you know, the better equipped you are to navigate the ups and downs of the markets. That's where economic data, commitment of traders, COT reports, and technical analysis come in. These are your secret weapons to unlock market secrets and boost your trading game. Think of it like building a house. You need a strong foundation, sturdy walls, and a reliable roof. Economic data is your foundation, COT reports are your walls, and technical analysis is your roof. They all work together to create a solid structure for your trading decisions. So, are you ready to build your trading fortress? Let's dive in and explore these powerful tools. First up, let's talk about economic data. This is the lifeblood of the markets. It tells us how the economy is doing and where it might be headed. But there's a ton of data out there, right? Don't worry, I'm here to break it down for you. One of the most important indicators is GDP, or gross domestic product. It's like the report card of a country's economy. A strong GDP means businesses are booming, people are spending, and the economy is growing. A weak GDP, on the other hand, is a warning sign that things might be slowing down. Next, we have the unemployment rate. This tells us how many people are out of work and looking for jobs. A low unemployment rate is a good sign, indicating a healthy job market. But if the unemployment rate starts to rise, it could mean trouble for the economy. And let's not forget about interest rates. These are set by central banks and have a huge impact on borrowing costs. Low interest rates encourage borrowing and spending, which can boost the economy. But high interest rates can put the brakes on economic growth. By keeping an eye on these key economic indicators, you can get a sense of the big picture and make more informed trading decisions. Remember, knowledge is power. Let's move on to another powerful tool: commitment of traders, COT reports. These reports give us a sneak peek into the minds of the big players in the market. So, what exactly are COT reports? They track the positions of different types of traders in the futures market. We're talking about commercial traders, the smart money, large speculators, hedge funds and the like, and small speculators, the little guys like us. Why is this important? Because it can give us insights into market sentiment. For example, if we see commercial traders heavily positioned in a particular currency, it could be a sign that they're bullish on its prospects. Conversely, if large speculators are net short, it might suggest a bearish outlook. Of course, COT reports are not a crystal ball, but they can provide valuable context and help us understand the forces at play in the market. It's like having a secret weapon that lets you see the other player's cards. Next up, we have technical analysis. This is all about studying charts and price patterns to identify trading opportunities. Think of it as reading the language of the market. There are tons of technical indicators out there, but let's focus on two of the most popular ones: trend lines and the relative strength index, RSI. Trend lines are like the roads on a map. They show us the direction the market is heading. An uptrend line connects higher lows and higher highs, indicating that buyers are in control. A downtrend line, on the other hand, connects lower highs and lower lows, signaling that sellers are in the driver's seat. The RSI is like a fuel gauge for the market. It tells us if a market is overbought or oversold. An RSI above 70 suggests that the market might be due for a pullback, while an RSI below 30 could indicate a buying opportunity. By using technical analysis, we can spot potential entry and exit points, manage our risk, and improve our trading timing. It's like having a roadmap and a speedometer for the markets. Section 5. Trend lines. Spotting the market's direction. Let's dive a little deeper into trend lines, one of the most versatile tools in technical analysis. Imagine a stock's price chart as a landscape. Trend lines are the roads that cut through this landscape, guiding the price action. An uptrend line, as we mentioned, connects the higher lows, those points where the price dips but bounces back higher than the previous dip. It's like the market is climbing a staircase, taking a breather at each step but ultimately moving upwards. This indicates strong buying pressure and a healthy upward momentum. Conversely, a downtrend line connects the lower highs. Picture a ball rolling down a hill, bouncing slightly with each bump but continuing its descent. This signifies consistent selling pressure and a bearish sentiment in the market. But what about when the price breaks through these lines? That's when things get really interesting. A break above an uptrend line could signal a continuation of the upward momentum, like a rocket breaking through the Earth's atmosphere. Conversely, a break below a downtrend line might indicate a potential reversal, like a bouncing ball finally losing its momentum. Remember, trend lines are not foolproof. They are simply tools to help you visualize the market's direction and anticipate potential moves. Section 6, RSI, Gauging Market Momentum. Now, let's shift gears and talk about the Relative Strength Index, or RSI, a momentum oscillator that can be your secret weapon in identifying overbought and oversold conditions. Think of it as a thermometer for the market, measuring the temperature of buying and selling pressure. The RSI fluctuates between 0 and 100. A reading above 70 suggests that the market is overbought, like a car running at full speed. It needs to slow down or even refuel. This could indicate a potential price correction or pullback as bullish momentum wanes. On the flip side, an RSI reading below 30 indicates an oversold market, like a stretched rubber band ready to snap back. This suggests that the selling pressure might be nearing exhaustion and a bounce could be around the corner. But here's the kicker: extreme RSI readings can also signal strong trends. For instance, an RSI persistently above 70 might indicate a powerful uptrend, while a consistently low RSI could reflect a prolonged downtrend. Remember, the RSI is most effective when used in conjunction with other technical indicators and your overall trading strategy. Section 7, the winning combination, integrating all three approaches. We've talked about the power of economic data, the insights from COT reports, and the tools of technical analysis. Now let's combine these elements to create a winning trading strategy. Imagine this. You're analyzing the Euro-US dollar currency pair. You notice that the Eurozone GDP is showing signs of improvement, and the unemployment rate is declining. This positive economic data strengthens your belief that the euro might appreciate against the US dollar. Next, you delve into the COT report for the euro futures market. You observe that commercial traders are net long, indicating their bullish sentiment towards the euro. This further reinforces your positive outlook. Finally, you turn to your technical analysis tools. You identify an uptrend line on the euro-US dollar chart and notice that the RSI is hovering around the 50 level, suggesting room for further upside momentum. By combining these three approaches, you've built a compelling case for a long position in the euro-US dollar. You've considered the fundamental backdrop, gauged market sentiment, and identified a favorable technical setup. Remember, this is just one example. The key is to develop a holistic approach that integrates these tools in a way that suits your trading style and risk tolerance. Section 8, Practical Tips for Trading Success. Now that we've covered the powerful combination of economic data, COT reports, and technical analysis, let's talk about some practical tips to boost your trading success. First and foremost, discipline. It's easy to get caught up in the excitement of the market, but sticking to your trading plan is crucial. Set clear entry and exit points, manage your risk, and don't chase losses. Focus on high-impact economic events. These are your golden opportunities to capitalize on market volatility. Keep an eye on economic calendars and plan your trades around key data releases, central bank meetings, and geopolitical events. Don't be afraid to use multiple time frames. Analyzing charts from different perspectives can provide valuable insights. For instance, you might use a daily chart to identify the overall trend and then zoom in to a 4-hour chart to pinpoint your entry and exit points. Risk management is your best friend. Never risk more than you can afford to lose. Use stop-loss orders to protect your capital and always have an exit strategy in place before entering any trade. Stay informed. The market is constantly evolving, so it's crucial to stay updated on the latest financial news, economic trends, and geopolitical developments. Remember, trading is a marathon, not a sprint. Be patient, persistent, and never stop learning. Section 9, Mastering the Markets, a Continuous Journey. As we wrap up our discussion, remember this: mastering the markets is an ongoing journey, not a destination. It's about constantly learning, adapting, and refining your approach. By embracing economic data, COT reports, and technical analysis, you're equipping yourself with powerful tools to navigate the complexities of the market. But remember, these tools are only as effective as the trader wielding them. Combine these insights with discipline, risk management, and a commitment to continuous learning, and you'll be well on your way to achieving your trading goals. So, go out there, stay informed, and trade with confidence. The markets are waiting.